What's up, everybody, and welcome to today's All Access show. I'll be your host, Nate Suleiman, and we've got a couple of great companies hanging out with us today where we get to ask some questions and get answers straight from the CEOs and the executives. And of course, you in the chat will go ahead and get to participate as well. But here we go. Let's get All Access started now. All Access is one of the ways that Benzinga monetizes our YouTube channel. Every company appearing on today's show has paid Benzinga to be here. We want to be very upfront about this fact. However, what they don't know are the questions that I'll be asking and the conversations that we'll be having. And of course, they do know to expect some questions from the chat as well. So we'd love for you to be engaged and let us know if you have anything that you would like to talk about. All Access is sponsored by Ticker.
What is Ticker? That's right, Ticker with two I's, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Ticker, where investors discover shareholder perks and consumers become investors in the brands they love. Ticker. Start tickering today.
If you want perks for owning company stocks, Ticker has revolutionized how everyday investors are rewarded for brand loyalty by connecting consumers with perks for the brands that they own. See what perks you qualify for today by going to ticker.com/Benzinga. That's TIICKER.com/Benzinga. Or to make life easy, just click on the link in the chat, and it's also in the description as well. Benzinga All Access listeners, please make sure you visit ticker.com/Benzinga, where you can register for a Ticker account, connect your brokerage account, and receive a $20 gift card once your account has been connected for 30 days. Well, we always talk about the best part about All Access is getting a conversation started with the executives. So without further ado, I do want to go ahead and bring on Marc Hedrick, who is the president and CEO of Plus Therapeutics, ticker PSTV, traded on the NASDAQ. Marc, how's it going?
Hey, Sinead. Good morning. How are you?
I'm doing great. Appreciate you being here and hanging out with us. I know you've got a busy day, I'm sure, especially on a Friday, right? You want to get all those things kind of done and taken care of ahead of the weekend, I'm sure.
You bet. Super busy, but nice to talk to you.
It's going to be a fun one. So, Marc, explain it to me like I'm five. What is it that Plus Therapeutics does?
So, Sinead, we're a biotech company that's going after some of the hardest problems in cancer. And the way we do that is we take targeted radiotherapeutics. Think about it like a little tiny nuclear bomb, a tactical nuclear bomb that goes right to the tumor, delivers a tremendous amount of radiation that overwhelms the tumor, but doesn't hurt the normal cells and tissues. That's a targeted radiotherapeutic. We're going after things like brain cancer. There's several kinds of that, including pediatric brain cancer, leptomeningeal cancer, which is a cancer of the fluid in the spine and the brain, liver cancer, and potentially pancreatic cancer. So that's what we do. It's an emerging area in healthcare and drug development, and we're super optimistic about the future for the company.
Yeah, those are definitely things that we would hope to not have be a part of our life or our loved one's life and things like that. I used to work for a company, and PanCan was like their charitable initiative that we
Yeah.
did. So I definitely, there's actually a book that was written by, I think it was like a professor that it was like his last lecture. Actually, I think that's what the book was called. I believe it was the last lecture. So that's kind of what that reminds me of. But let's go ahead and dive into a little bit deeper of solving such an issue is not something that's easy, I'm sure, right? Especially with the research that goes into it and the challenges that you face. Can you tell us a little bit about what those challenges are as you're working to develop the treatments at Plus Therapeutics?
Sinead, we're going after some really tough problems. So on one hand, why do you think that we could tackle those, right? So
Yeah.
a lot of people have tried to tackle pancreatic cancer, brain cancer. In fact, in patients that have brain cancer, there's been no new treatments approved over the last 10 years. And the one that's been approved really doesn't work that well. It's really more for symptomatic symptomatic improvement. But we think the technology is a big part of the key. Um, Targeted radiotherapeutics are really on the upswing. There's one targeted radiotherapeutic that's used for thyroid cancer that's been around forever, but the targeting mechanisms really haven't been there. The nuclear power or the radiation and all that's sort of been there for a while, but the key is figuring out how to target it to the cancer. So we're sort of agnostic as a company to how the the bomb gets targeted to the tumor, right? So, for example, in the brain, we use sophisticated software to map the tumor out, compute how to put very small, tiny catheters directly into the tumor, and then we essentially frack the drug into the tumor. But why didn't this happen before? Because that targeting technology and mechanisms didn't really exist.
Yeah.
Uh, so it's a combination of new technologies in different fields in engineering, imaging, targeting, new catheters, and then the drug design that we have is very unique in that it leaves the radiation on the tumor literally for weeks. So we could just the radiation keeps pounding away at the tumor. These are all the confluence of all these sort of innovations. It really kind of made us or put us in a position where we can actually do this, where we couldn't do it in the past.
Yeah, and of course, all of these things that you guys are working on, it isn't easy. It isn't easy, but it's definitely not cheap either, right? So let's kind of dive into some of the
Yeah.
recent news that we have, especially about the $17.6 million dollar grant that you got, I believe, from the Cancer Prevention and Research Institute of Texas. You've got the grant. Tell us
Yep.
a little bit about that and how you're planning on using this to kind of further explore the missions that you're going with.
Yeah, so we were really stoked to see that we had been awarded that grant. I think it's one of the largest grants that CPRIT has approved for product development for a company. As you may or may not know, CPRIT is the second largest funder of cancer research in the world behind the NIH. Believe it or not, Texas voters have allocated $6 billion to
Wow.
cancer funding that is specific for the state of Texas, both for academia and for companies in the cancer product development space. So, uh, kind of building on our brain cancer work, we devised a way to treat patients who it's about 120,000 patients in the US every year where their breast cancer, melanoma cancer, lung cancer metastasizes to the fluid space. And there's a real need. If there's no good treatment on the market, these patients live 4 to 6 weeks after diagnosis without treatment. And even the treatments that are out there are not that great. It's sort of a kitchen sink approach. So the CPRIT grant, nearly $18 million, allows us to go from the first few patients that we've treated already all the way through phase two. So that's about 120 to 150 patients. And the way the grant's constructed, it's a two-third, one-third grant. So the state of Texas kicks in approximately $18 million, and then we fund the approximate other $8 million or so. And it's a 3-year grant, and it's real money. It's coming in literally this month,
Yeah.
and and you can get more. So it's really a great source of non-dilutive funding. It's very shareholder friendly. Um, and the state of Texas is great to work with. So we're super excited about that.
Yeah. And I know on and in terms of PanCan, they've got the walk that they're having. I believe it's called the PanCan Purple Stride later on next year
Yep.
in April as well. So they're clearly involved, and they care about what y'all are doing over there at Plus Therapeutics. Do you plan on getting a grant with the NIH? By the way, is that something that you're able to give us a little bit of insight on?
Well, it just so happens we have one. So we're in a unique position as an up and coming biotech company where our two lead programs, both of them are fully funded through phase two. The one I just mentioned
Right.
is funded by the state of Texas. The other one that for brain cancer is actually already funded by the NIH. So through our principal investigator, Dr. Andrew Brenner at the Mays Cancer Institute at the University of Texas, San Antonio, and MD Anderson, uh, he has a grant that actually funds this trial all the way through phase two. So we're leveraging that today. So we're in a great position. That's great capital that we can apply to these trials, and that's capital we don't have to go out and raise the markets. That's part of our strategy is to be very shareholder friendly in how we fund the company and look for ways to raise and deploy capital in the most shareholder friendly way.
Now, I know when it comes to earnings, you guys are going to, I believe, possibly report earnings early November, possibly in the first 10, 15 days of the month there. But let's kind of reflect on maybe the previous earnings, right? And maybe any
Yeah.
highlights from there that you want to discuss. And of course, I know you got to follow SEC rules, but any insight you want to give on what investors and possible investors can expect in November when you report again.
Yeah, I think actually, I think earnings are next week. We're in a very short time frame. We report very early. So, I could tell you from the last earnings call, it was really all about enrollment and data. So we announced a number of milestones. We hadn't announced the CPRIT grant. That was a subsequent event. Uh, but we announced that we were going to be reporting data at the European Society for Medical Oncology. That's one of the largest uh, oncology meetings in the world. It's the biggest one in Europe. It's once a year. This was in Paris, and the principal investigator in the trial presented the complete phase one data set for our RESPECT glioblastoma trial. And at that trial, he reported the outcome of 24 patients that had received, in a dose escalation fashion, our 186 RNL drug for recurrent brain cancer. And essentially, what it showed is that we've had no dose limiting toxicities. The drug has been very safe. There appears to be a dosing threshold at 100 gray. And what 100 gray is, gray is a measure of the amount of radiation. So typically, patients that have glioblastoma get 35 gray. That's with external beam radiation that goes from the outside in.
Yeah.
So with our drug, we're not giving 35 gray, we're giving almost 600 gray. So close to 20 times the amount of radiation. And we showed that if you can get over 100 gray, you can prolong survival by approximately 2 years. Statistically significant improvement in survival of 2 years if you get greater than 100 gray. It's very compelling data, and that's going to drive the trial into the phase two, which will be starting relatively soon.
Yeah, that 20x improvement is definitely something that should help patients out. Now, we've heard so much talk of like inflation and the macro events and different things like that. Does that hinder anything that you're doing at Plus Therapeutics? Does that impact the business side of things or the research side of things with costs possibly going up? Or is it kind of like, hey, we're not necessarily impacted with inflation and different economic factors that are currently that we're dealing with as average Americans?
Well, you're right on, and actually gave a lecture last night about the capital markets to about 100 people in the biotech space. And right now, the thing that's driving stock prices in biotech is more than anything else are macro issues, believe it or not. Macro right now. And then there are a lot of potential risk on the horizons that could make a recovery prolonged. So we, having done this a few times before, Junaid, we have a very low cost structure. We operate in kind of a hybrid virtual model. We've been building up a war chest in anticipation of financial challenges in the future. And we've been leveraging other sources of capital like grants to fund our program. So we run very lean, very slim. We have cash through 2025. Um, and we're very opportunistic. When there's an opportunity to raise capital at a very low cost of capital, we will. And we've done that over the past 3 years or so, but we're very selective in that. So we'll continue to do that. We're fortunate to be in a very good place. There are a lot of companies right now that that need to raise capital that are going to struggle, and fortunately, we're not in that place today. So I think we just continue to keep our heads down, work hard, execute. We have a very clear product development plan, which includes being cautiously acquisitive when the right opportunity in the targeted radiotherapeutic space presents itself. But we're going to keep our heads down and keep executing.
Gotcha. Now, when it comes to something that the investors can look forward to, I know we kind of briefly talked about the earnings fact and things like that, but I want to kind of look at maybe 6 months to a year and maybe even 5 years down the road if you want to talk about what potential investors can kind of expect from you, the company, whether it be milestones, any different testing you're looking to get into, whatever it is that you believe they should know when they're looking at Plus Therapeutics.
Well, so let's take the longer term kind of broader view first, and then it's going to zero down to what's in the year ahead or so. So The idea here is to build a targeted radiotherapeutics company, uh, bring a significant product to market, build a portfolio behind it, and then try to partner the company or have an exit in the next 3 to 5 years. So that's we're focused on building out that valuable pipeline. We're talking to potential partners today. We're learning what potential partners or acquirers would want to see in a targeted radiotherapeutics company. It's a relatively small space, so we're really trying to build a company towards that exit that's good for shareholders. So that's kind of point number one, and that's sort of a 3 to 5 year time frame in my
Yeah.
view. So what about how do we do that? Kind of looking more over the next year or so. So we have now really two lead indications, one for two kinds of brain cancer. Both are funded as I mentioned. Brain cancer is going into a phase two. We've had two good conversations with the FDA on that. So we want to get that phase two trial enrolled as quickly as we can, and tee up a pivotal trial in the next year and a half or so. On the other hand, this the leptomeningeal trial that's funded by CPRIT, we want to get that into phase two as quickly as we can. That data looks extremely promising, so we want to get that into phase two. We just did an acquisition of a very unique technology. It's called a radioembolic technology. There's a couple of products on the market that split about $1.5 billion market for inoperable liver cancer. Basically, you drive a drug through a catheter into upstream in the blood system of any tumor, and then you infuse the blood system with something that blocks the bloodstream, but then elaborates massive amounts of radiation directly and only to the tumor. And then this drug is designed so that it goes away in a few weeks. And so then you can go back and retreat them. So that's a novel new drug you can address potentially any cancer with, including pancreatic cancer. And the goal is to get that into the clinic next year. Plus another drug that's in the market, that's in the clinic, hopefully for pediatric brain cancer next year as well. So we've got a lot of things. We're pushing the programs we have to the next level, and we're bringing on new programs to help build out that pipeline, all in hopes of kind of meeting our target of an attractive exit for shareholders in 3 to 5 years.
Yeah, well, I know folks will be looking forward to that phase two, and especially it's nice that there's a company that you've now acquired and you have access to that can help you with taking care of at least one of the challenges that you might face in the research and development, and just kind of testing out the stuff that you guys are doing. Now, one question for me is, I guess it's kind of like the
Yeah.
floor is yours, right? Because, well, let me do this. Let me ask you about your competitors before I give you the floor, because I'm sure you're not the only one possibly in this space in the big scope of things. So I'd like for you to kind of maybe not necessarily talk about your competitors, but I'd like to know what edge you believe you have in this space and what you're looking to do, versus someone else that might be looking to do the same thing.
So let me talk about competitive technologies generally, and I'll limit my comments to glioblastoma and leptomeningeal cancer. So really, our competitor is technology that's been used in patient therapy for over 50 years, and that's external beam radiation in both cases. Um, we have an opportunity to disrupt something that's been in the market and been the gold standard for 50 years. So rather than delivering radiation from the outside in, blasting it through, the normal tissues to get to the tumor, we're putting the radiation 20x the amount of radiation directly into the tumor and only the tumor. That's the idea. So that's the competitive landscape in
Yeah.
short, and we think we have a significant advantage because of all these different technologies we sort of pull together to make this happen. Um, so if you look at other drugs and things that are being developed, monoclonal antibodies, checkpoint inhibitors for different kinds of cancers, we're actually synergistic with those. We don't think that those are competitive. In fact, we think we'll be synergistic. For example, in leptomeningeal cancer, one part of that development program is to look at our radiotherapeutic in combination with some of these checkpoint inhibitors that that may work synergistically. So both are actually better when they work together. So we see in some ways these non radiation related therapies as potential synergistic players that we can work together with. And we plan to partner with those companies to look at those studies and see if we can make the combination work better than either one individually.
We talked about the grant information already, right? We talked about the $18 million grant that you got.
Yeah.
Well, let's talk a little
Yeah.
bit about maybe just the overall financial health of your company. If you could give us a little bit of insight on that.
Yeah, I think, generally, I mean, in earnings next week, we'll provide an update, but I think kind of looking back at the last quarter, you could sort of piece this together. Company notionally, right? So we don't, we have an $18 million grant. All of that cash is not on our balance sheet today, but we hit milestones, that cash will come in. Um, we've got cash to get the company through into 2025. So and it kind of depends on our spend and what we might do in terms of being acquisitive uh, and developing additional programs, whether it's well into 2025 or just into 25. So we have some optionality there. But I mean, we're close to $40 million in notional cash, including the grant cash plus cash on hand, and we're burning somewhere around, five to $700,000 a month, and that's going to be relatively stable because the grants will cover what we intend to spend over that time frame. So, um, and then we'll look for opportunistically to raise cash when the markets come back. But you kind of brought up the issue about the macro issues. I said I'm concerned about the macro environment. I think in kind of a best reasonable case, I think we have a recession in kind of Q1, Q2. Hopefully, the market starts to recover around the time we're at the nadir of that recession, meaning, things come back in the market, maybe early to mid next year. That's best reasonable case. But, if something geopolitically or from a macro perspective happens, it could slow that down. So I think we want to be very conservative with our capital at this point, marshal that capital, focus on value creating milestones in the short term, and then look for opportunities to raise cash or to grow the company.
I appreciate the insight on the financials there. And again, as you said, you will be reporting earnings next week. So we will definitely be on the lookout for that and hope to have a conversation with you. But before I let you go, though,
Yeah.
I'm sure there might have been some things that you want to discuss. Is there anything that you want to talk to our viewers about? Anything I didn't bring up? Any topics you wanted to cover? The floor is here. Floor here is all yours.
Yeah, want to talk about some of the hospitals that we work with and some of the supporters of the technology. So, oftentimes, particularly for retail investors, you may not have an MD or a PhD or have experience in healthcare drug development. It's hard to know, what's attractive or what's not. A lot of big words and a lot of science, and it's hard to sort through that. Um, I think one thing you can do is kind of look at who you're partnered with. And if you look at like our website, you see the doctors that are involved in our trials and our technology, the hospitals, MD Anderson, University of Texas. Very soon, you're going to see some new, very well-known, famous hospitals throughout the U.S. that are involved in our trials as we expand our phase 2 in breast cancer, for example. And also look at things like the NIH supporting our trial, CPRIT supporting our trial to the tune of $18 million. I think we have a lot of supporters and experts in the field that are involved in technology and have helped us, frankly, develop the technology and continue to contribute in a very meaningful way to the overall development program. So I just want to highlight to the people I know it's hard sometimes to sift through what's good technology or what's not. And biotech can be very risky because of the regulatory and clinical hurdles. But if you sort of align yourself with the thought leaders, that's a pretty good place to be.
I appreciate the insight on what you guys are doing with working with the hospitals there. And I want to just confirm you're reporting earnings on October 20th. Is that right? After market closes?
Yeah, I think that you're really trying to pin me down on that. I think it's
Okay.
next. Yeah, I think it's next Thursday.
Gotcha.
Is
My
that the
apologies on
20th?
that. Yeah.
Is that the 20th? Yeah, I think so.
All right. Well, Marc,
Yeah.
thank you so much again for being here. We appreciate you having the conversation with us, and we look forward to having some more in the near future.
Okay, thanks. Appreciate it. Take
No
care.
worries.
Have
Take
a good
care.
weekend. Bye
You
bye.
too. Bye bye. Again, that is Marc from PSTV Plus Therapeutics. We appreciate you guys hanging out and joining us for that interview. We've got plenty more to come. And here's the next one from All Access.
We've got a really exciting conversation coming here today with Brian Freeman from Real Good Foods. We're going to talk about the food industry, how they're shaking things up, what their growth looks like, and some really impressive stats that have been coming from this. Well, it's a great company to keep an eye on. So without further ado, we're going to jump in and start with our single company presenting in All Access today and bring on Brian Freeman from Real Good Foods and get started. Brian, great to have you here. How are you?
Hey, Michael, nice to see you again.
Always great to have you here, Brian. It's a really exciting day. Like we mentioned, we're in our fourth quarter meeting. We've got you here on All Access. A lot of great stuff going on here on a Friday to close out the week. Let's go ahead and get started. For anybody that wasn't here in our investor audience the first time around to speak with you in Real Good Foods, give us a high-level overview of the company and what you guys do.
Yeah, I mean, at Real Good Foods, we're just modernizing frozen food right now. For us, that means our job's to make craveable, delicious items, products, food that we all want to eat, but take the carbohydrates and sugar out of it and replace it with protein. You know, when you think about over the years how our food system has just put a lot of grains, carbohydrates, and sugar into the things that we want to eat, what it's led to is a lot of problems, health problems. You know, a third of the U.S. unfortunately has either diabetes or is pre-diabetic. 57% of all U.S. adults tried to reduce their carbohydrates over the last 52 weeks. 40% of us are clinically obese. And, you know, I don't know about you, Michael, but if left to my own devices, I'm going to eat a lot of Mexican food. I'm going to eat pizza. I'm going to hit the lasagna really hard. And, you know, we just figured out that we got to stop doing this. We're not going to stop eating and craving what we want. What we got to do is get the grains and carbohydrates out and replace it with protein. And so we started that journey about 5 years ago. And the good news is we've grown really fast. We've gone from essentially a small little D2C business doing about $500,000 in revenue online. And, you know, just this last quarter, we updated our guidance and we're guiding towards 155 million to 160 million of revenue this year. And we think that, you know, we can get to $500 million in revenue in the medium term. That's our goal to get there in the next 3 to 5 years. And it's just because we're satisfying a big need, and obviously the food's got to be delicious. So that's our mission. For me personally, it's really cool to, you know, actually, I feel like, you know, we have an opportunity to make a difference in people's lives, but at the same time, build a big business that, you know, has an impact. So that's what Real Good Foods is all about.
Well, it's awesome, and I'm glad you mentioned that. It's funny. There's a Mexican restaurant that's not too far from where I live that I go to with my brothers every single Saturday. It's like our weekly tradition. So I know what you're saying, right? If I had a choice, I'm going to go to that Mexican restaurant. It's called Puerto Vallarta. I do it every Saturday. I love that food, right? And it kind of plays into our next point here, which is if we're going to continue with the same habits that we have and everything, what are some challenges that you think you and Real Good Foods have faced in this industry where you guys are bringing health, conscientious choices to an industry that oftentimes seems to value quickness and efficiency and just getting that quick food that tastes good, makes us feel good, and we go on about our day? What are some of the challenges in introducing this healthy style to this kind of food?
Yeah, I mean, convenience has always been the hallmark of frozen food, and we're no different. You know, most all of our items are microwavable, just like what you would expect to get out of frozen food. The trouble is, as I said before, frozen food really isn't good for you, what's on shelf, just because of the way it's designed, not, you know, the convenience factor. So what I'm really trying to say is there's a lot of brands out there that market themselves as better for you, but in the frozen food section. But when you flip the package over and look at the nutritional fact panel, you know, there's no difference between what's in that product and, say, a Hot Pocket, you know, loaded with carbohydrates, sugar, and very little protein. Here I've got, you know, our enchiladas, and, you know, what we did here is we made a tortilla out of chicken. It's really delicious. And, you know, instead of 25 to 40 grams of carbohydrates, we've only got 3. And this particular product has 38 grams of protein. So we make everything from scratch over here. The sauce is a fresh tomatillo sauce where we're bringing in the fresh produce, and it's just beautiful food that, the more of it you eat, you're just taking in protein and leaving aside the sugar and carbohydrates, which Michael will allow for a couple of beers when you're out there with your buddies eating Mexican food. And by the way, it is Friday, so wanted to raise that as well.
Looks like we got both of us back at the same time. Brian, can you hear us okay? Everything good on your end?
Yes, I was just talking about beer.
My favorite part, I missed it. Great. Yeah. Well, no worries. Looks like we've got you back now. We had a little bit of a connection issue for a second, but no problem. Finish your thoughts, start off wherever you were, and then I've got another point I kind of want to build off with where you were going.
Yeah, I was just talking about our brand attributes, but let's go on to the next question, Michael.
Perfect. Well, so I like where you're going with that. And I want to talk a little bit about how this all comes together, right? With your approach to the food industry and what you guys are doing to bring health into it. Let's talk through how you source the ingredients for your food. How do you guys put this together? What does the process look like start to finish in your manufacturing, your production, the process of your products actually getting from your facilities to getting out there in those stores and ultimately to consumers' tables?
Yeah, sure. So, first it starts with the team. Our management team has decades of experience. Me personally, I've got over 20 years in the frozen food industry. And so for this industry, it really does take an experienced team that's used to running large businesses of scale. Myself included, we've all been parts of SLTs of multi-billion-dollar businesses, and our board of directors is no different. And so I think the food business, because it's been consolidated and is dominated, in the case of frozen food, by 3 large multinationals, experience matters. And so you use that experience to put in state-of-the-art manufacturing processes and plants that can execute and make sure that we're not converting our raw materials at a disadvantage to the multinationals. And so, to that end, when we went public regular way back in November, those proceeds from going public went into the business. It did not go to any shareholders, and was used to build a massively scaled plant out, in Bolingbrook, Illinois. That plant can convert, has conversion costs no different at the same low rate as what you would expect for a multinational. So today our manufacturing footprint is 2 plants. Today, I happen to be in our City of Industry plant, which is located in Southern California. And then our new plant that came online in March in Bolingbrook, Illinois, is where over 90% of our products are produced. The other point I want to make is we don't just assemble components. We take raw material, in the case of our proteins like chicken or beef, it's coming in raw, we convert it. Why is that important? You need to be able to do that in order to make margin and be a profitable business. And to that end, we have publicly said that we will be adjusted EBITDA positive in Q4, and we will be EBITDA positive in next year. We brought that a full year forward from when we went public. Our guidance in November of last year was EBITDA positive in 2024. When we saw the markets turn over, we got together as a team and said, look, yes, we believe we can grow this business at a high speed, but we're going to do it responsibly and make sure that we're making money and we're EBITDA positive. And so, if you look at our guidance for this year, we almost doubled the business. We like, what we're seeing in our new products, which I know we'll talk about in a little bit, that will continue strong growth, but we're here to be EBITDA positive in next year, 2023. But it all starts with the manufacturing footprint, Michael.
Absolutely. Makes a lot of sense. And you mentioned a couple of things there that we're going to dive into. And I want to get more of a realistic picture of the entire landscape around you guys too before we do that, because it's a point that we like bringing up with a lot of the companies that come on All Access, because the last couple of years have been turbulent, I think is a very safe word to say. And for you guys specifically, right, with the shipping and the manufacturing and everything that you guys are doing in your industry, how is the COVID pandemic and especially the economic times we've had over the last years? It's been a choppy 12 to 24 months. Has anything changed in your business model, the way that you guys do things? Has anything been affected? And how have you guys handled the last couple of years overall as a business?
Yeah, I mean, look, it's been tough. I mean, you listen to everybody's quarterly calls. We saw things occur over the last 6 quarters that never had happened before. You know, difficulty with labor, difficulty with suppliers, unpredictability. We managed through that, obviously. We're able to grow the business, but I'd like to talk about where we are today. Here's where I can give you some of the good news. Number one, labor markets have settled down. You know, the biggest impact to margins and to the supply chain last year, and I would say Q1 of this year, is just reliability of workers showing up. What we're seeing today is attendance rates back to normal, well above 90%, and people want to work. So labor has stabilized. Secondly is commodity costs. You hear a lot of companies talking about high price of commodities. Good news at Real Good Foods is our poultry, which is our number one commodity that we purchase. We buy over 1 million pounds a month of raw poultry, has really come down significantly in the last 4 to 6 weeks. To give you a perspective, for a typical spec that we use for our products, you know, the historic mean, you know, going back 5 years, has been somewhere in the $1.45 to $1.50 per pound cost basis. We saw in Q1 and early Q2 pricing as high as over $3.60. Incredible. You know, I've been in the business a long time, never seen anything like that. We got through it. Happy to report today that we're buying poultry now in the 165, 160 range. So we're starting, the material's starting to turn over, and we expect it to revert back to the historical, you know, 5-year mean, which is material to our business and profitability. We're seeing that in paperboard. We're seeing that in freight. So lots of relief is coming and is already here, and we're going to take full advantage of it.
Absolutely. So, okay, great recap there of the landscape of where you guys sat and how things have affected you guys. So let's talk about recent events then, right, and everything that's exciting going on right now. The release that you guys had of your Asian entrees, the orange chicken, the General Tso's, all this new stuff you guys have brought out. How's the market reaction been to that, the consumer reaction been to that so far, and how are your new products rolling out to the market and getting received by the general public?
Yeah, I mean, this is what really excites me personally. You know, we are a hit-driven business, and you know, we launched a high-protein, low-carbohydrate chicken nugget and chicken strip into the marketplace a couple months ago. I've never seen a product go from, you know, just launch to number one. It is the number one better for you frozen breaded poultry item in the retailers are at. I've never seen that happen. And we're actually in the top 15 percentile of velocities of all you know, items in the frozen poultry and meat section. Okay, so that what that's telling you is we're outselling the majority of Tyson and Purdue SKUs with our item. And on a dollar per facing standpoint, these are very productive SKUs, selling close to 4 times what a enchilada would sell for, or what a typical Amy's entree would sell for. So we've got a winner here, and our job is to just grow the distribution, and I like our chances of that in 2023. Asian entrees, the story is similar. You know, when you look at orange chicken, if you go to Panda Express or whatever, product's delicious, but the problem is it's got over 40 grams of carbohydrates, 25 grams of sugar, okay, per serving. Our solution delivers only 3 grams to 4 grams of carbohydrates and 23 grams of protein, 1 gram of sugar. So that product is coming on shelf now. I love the velocities we're seeing. It's in the top quartile. And so I think that's really going to be our growth story for 2023 and frankly, Q4 as well. Again, I'm a pretty optimistic guy. The velocities we're seeing exceeded even my, you know, expectations. So, and the good news is we've got the capacity because we've made the investments in the plants in Q1 and Q4 of last year. And so it's a pretty nice setup. right now. And then when you see where the stock's trading for those value investors looking at us, we're trading at like 1 times our guidance for this year. So I think it's a great entry point for investors as well.
Awesome. Okay, and talking about the entry point for investors and everything else, if we've got a line on how this is being received, and clearly things are going well with this so far. So take us through your Q2 earnings report. How did this reflect in how you guys are looking at this from a financing standpoint, where the company sits on a business standpoint right now? Any highlights that we can pull from, and anything to look forward to in Q4 as well on the financing side, the marketing side, and clearly, like I said, with things being so well received, what are the growth points to look for over the next couple of months?
Yeah, you bet. So for Q2, we didn't get the benefit of our innovation and our Bolingbrook plant. The revenue generated out of that plant was not, it still was coming online. So I think what we're talking about in terms of meeting our guidance, it's really playing out in Q3 and Q4. Remember on the Q2 call, we raised and beat guidance. It was our third consecutive quarter of raising guidance we're guiding to 155 to 160 for the year. And so, and I think for 2023, where consensus guidance is from the folks that cover us over at Jefferies, William Blair, Truist, and Roth. I mean, I think consensus estimates for next year have us right around 195 to 200. And, and again, in this marketplace, I think it's important to be EBITDA positive, and that's what we're working hard to achieve. But, you layer on the innovation and the success that we have, I feel good about the coming quarters. At the end of the day, velocity is everything in this business. What's velocity? Velocity is, how many units are you selling of your product versus your peer group per store per week. And, if you're at the top 15% of an item, the prospects of growing distribution in that item are very good.
Outstanding. Now, again, when you're talking about that growth too, and some of these prospects, a real feather in your guys' cap is that you are actually in the top 15% in terms of velocity in your sector, your industry, your specific group. It's obviously a testament to what you guys are doing, and everything you just covered sets us up to understand why you're in that top 15%. But going forward, with all the growth that you guys have, and obviously a lot of positive catalysts, I want to take a look at your industry really quickly too before we close, right? There's a lot of things. Again, we talked about the turbulent markets. We talked about the choppy supply chains. Is there any road bumps or potential issues that you see in our market when it comes to rising inflation and the Fed doing everything that they're doing? Anything that you see as far as issues for your entire industry, but for you guys specifically, that you need to be on the lookout for and you guys are going to be looking to address over the next couple of quarters, the next couple of years?
Yeah, I mean, I think that the Fed is sort of behind the times. We're seeing commodity prices coming down. Okay, so I think that this inflationary impact from what we're seeing on the commodity side has already abated. I'd like to just go back to the industry, though, of frozen food, and remind your audience that frozen food in the U.S. is a $58 billion category. It grew at approximately a 6% CAGR. Within the frozen food industry, products that are like ours that are marketed as better for you account for about $9 billion of revenue, growing at a better than 6% CAGR. So, we talk about our guidance of 155 to 160. We're still a small business with a huge TAM to go attack. So you overlay the size of frozen food, 58 billion, and then go back to the fact that you've got half the population trying to reduce their carbohydrates. So to me, and I can tell you as a management team, we think that we should be growing even faster because of the huge opportunity, and that's what we're working against. So big industry, highly differentiated on trend brand, and we just are going to go execute over the coming quarters.
Outstanding. Well, it's exciting to see, Brian. It's always a pleasure to have you here. Every time you guys come in, it seems like there's something new and exciting in your pipeline, and the positive story just keeps moving. So there's a lot to look out for here. Obviously, a lot of exciting things in the future, a lot of stuff coming up in the rest of 2022, even though we are here in the beginning of Q4, and it seems like we just started Q1 a couple of days ago sometimes. So, Brian, always great to have you here. Thank you so much for joining us.
Thank you, Michael. Nice to be here.
We're going to go ahead and get rolling and bring our first company on this morning, Tricia Sims, the CEO of Aleafia Health.
Good morning. Good morning. Thanks for joining us, Trisha. Where are you coming to us from?
I'm coming to you live from Toronto.
Thank you so much for being here, Trisha. It's a beautiful morning here in Detroit. Hopefully the weather's good in Toronto there as well. We're very excited to have you and Aleafia joining us. So get us started. For anybody here that hasn't heard of Aleafia Health before, what is the company all about? What's your stated mission? Give us some background here.
Yes, absolutely. So Aleafia is a Canadian licensed producer in the cannabis industry. Our goal and vision really is to become one of the top 10 leading licensed producers in the adult use segment. We focus on adult use, medical cannabis, international. We are a rising star among the industry, and we're really focused on bringing branded cannabis products in our portfolio. Our mission is really to build a global cannabis brand through education and research, the development and advance of cultivation and science, and really having Canadian-produced cannabis products.
Outstanding. Okay, so take us through some of the specifics of the business. What are some of the challenges of operating medicinal cannabis clinics? There's so many interesting things that you guys do. Obviously, you have the products in your company as well. But what are some of the challenges you guys have faced? And how do you feel your business has evolved over the last couple of years, overcoming obstacles, overcoming challenges, and that sort of thing?
Absolutely. If you go to actually the first slide, I can give you a very good overview, the focus and the transition of the company. Aleafia started out as mostly a wholesale producer of cannabis. They had a small medical footprint, and they were not a player by any means in terms of the adult use sides of the business. And as you will have seen in the Canadian cannabis industry, it was largely a wholly medical business up until legalization, where you saw the adult use type of portfolio start to grow rapidly across the industry. As a result of that, we've seen the medical side of the business decline as patients have had greater access to adult use products. The availability of retail chains and stores has increased, and also the opportunity to purchase outside of just flower, but 2.0 products. And all these products have been readily available on the recreational side of the business. So for Aleafia, we've taken a strategic stance on how we can transition our business from being largely a wholesale producer into focused on branded cannabis revenue. And there's really three core areas that we've positioned the company. First is to become a leader or a top 10 adult use player in the recreational side of the business. And I'll spend a few minutes talking a little bit about our flagship brand, Divi, and the significant rise that that's had, really focusing on value-based cannabis for consumers, where you receive exceptional quality of product at a price that is affordable, and really creating a strong following there. I can share with you that historically 90% of our revenue would have come from wholesale product, and now we have 90% of the revenue that is actually coming from branded cannabis products in market. Have developed a very strong following behind that brand, and are the second fastest rising LP in terms of retail growth and pull through as of last quarter. The other core differentiator of our business is we focus on the medical cannabis side of the business, where we have significant leadership. The medical business is different in the sense that patients there are usually patients with requiring chronic therapy with prescriptions, and require specific types of medication across not only nutraceutical, but health and wellness. And we offer a platform where these patients can receive a prescription, they can be educated, and then they can receive their product and delivery within the same day. It's a large differentiator in the cannabis sector in the sense that it is higher margins, it's more sticky recurring revenue, and we've now rose to the second largest LP in terms of medical cannabis with over 7.5% market share. So that's a significant differentiator than some of the other Canadian licensed producers, in the fact that we have two very strong chains that contribute to our revenue. And the third one, which is a growing sector for us, is the international side of the business. As you will see, the European market is starting to evolve. Right now, it's just a medical cannabis legislation there, but there is anticipation that recreational use will become legalized in the next few years there. And Aleafia has established direct partnerships and distribution channels on the international side of the business, again, differentiating us from some of the traditional Canadian LPs who just focus more on the domestic adult use size. The international side of the business allows for significant growth of the company. It is the highest margin stream for the organization, and it is one that represents the strongest growth potential. So when you look at these three groups together and how we positioned our portfolio, it's really allowed us to transition the company from a lower margin wholesale producer into a very strong branded cannabis company.
Outstanding. Okay, and we want to talk a little bit about the cannabis products too, right? The products that you guys actually have. You mentioned wholesale and everything else earlier. Talk a little bit about some of your products in detail, some of the ones that you guys are most proud of, and some of the best performers too for you guys.
Excellent. So I'll start with Divvy. So Divvy is our flagship adult use brand. This product focuses specifically on everyday cannabis. It's also focused on high volume, high margin, and it allows us to be able to compete in a variety of sectors, including flower, pre-rolls, and vapes. Those are the three largest categories within the Canadian adult use sector. Most recently, our Divvy brand has hit the top 10 and top 5 and 7 position in milled flower and pre-rolls, and we continue to see excellent growth on the vape side of the business. We also focus on another health and wellness brand, our Noon and Night portfolio. This is more of a CBD focused health and wellness lineup. It allows for CBD topicals, capsules, as well as bath products. This helps for your kind of everyday wellness routine. In addition to more of a nutraceutical play, we have products that help with sleep. We've combined some of the traditional nutraceutical products like melatonin with CBD, in addition to omega-3 with CBD. And you see products such as these that are allowed really to help patients who are suffering from chronic conditions, anywhere from anxiety, pain, sleep, health and wellness, and really products that help with your everyday health and wellness routine, from roller balls to topicals and bath bombs. We've really created a segment within the market across both the medical space and the recreational space where consumer health and wellness products could be front and center. The other part of our Sunday market portfolio is a Bogart's Kitchen. We've taken a decision to look at innovative products that can be used within your everyday lifestyle. They focus on unique edibles in addition to a sea of gummies and chocolate. We really stand by doing things different within this category. We have a unique infused hot sauce that can be used in everyday cooking and life that has been one of our top sellers. We're also coming out with maple syrup, and this is going to be an infused brand that really can help differentiate in the market with products that are, everyday Canadian used products, but where we've been able to infuse them. We infuse products sometimes in partnerships, and we've done that really to increase our presence and reach across the more, stoner crowd who are looking to gain access to products that they're more aficionados and interested in some of these unique derivatives. And then lastly, Nith and Grand is our craft portfolio. And all of these brands fall under our Sunday market house of brands. We felt it very important to be able to offer differentiated products to our consumers from value all the way to craft. Our Paris facility is a craft designation, which allows us to produce very consistent, high quality THC premium products at high level of quality and flower that we bring to the market. And last but not least, certainly is our kin slips, which are an excellent product that are used both recreationally and across the medical portfolio, which are a sublingual strip that goes right underneath your tongue. It acts very fast acting within 15 minutes, both in CBD and THC portfolios, but it's really a product that you can take for consumers that are on the go. And I guess if I was just to summarize up the entire portfolio, we've taken a very thoughtful approach to bring products to the market that are already part of everyday consumers' practice, but adding the benefit of adding CBD and THC to these products.
Yeah, so the thoughtful approach is very apparent, right? And I guess what I want to go into more detail is when you look at product development and your new product pipeline and anything new that you guys are looking to add, how do you stay on top of consumer trends, your consumers' trends, right? What people are looking for, what you think is going to be popular next. What do you guys look into in the future to determine what's going to come down your product pipeline and onto your shelves next?
Yeah, no, I think that's an excellent question. The cannabis industry is a very fast-paced, dynamic industry that literally changes weekly. As product development, we really look to understand the consumer's needs and specifically what is their focus and what are going to be products that we know that are going to be high margin, that are going to be consistent sellers, and that are also extensions to lines that we've already created that are very successful. So we do spend a lot of time understanding the consumer demographics and their needs. If I was to share with you, a little bit where we're focused on, the three largest categories within the sector are flower, pre-rolls, and vapes. We take a leadership position in two of those, and we're consistently looking at how we can expand our Divvy portfolio and bring products that are line extensions within that. So a couple examples are the US market is always kind of leaders in what is to come next. Specifically, we've seen a huge growth in infused pre-rolls in that market. That's been slower to take hold in the Canadian market, but we're starting now to see that this is an area where you could take excellent quality flower and infuse it to be able to achieve those higher THC levels. This is now within our sites where we have looked to expand our Divvy portfolio across that level. Excuse me. Our Divvy pre-rolls are something that we're also expanding. Currently on the market, we have 0.35 by 12 and 7 gram by 1. This is a category where we take a significant leadership position just based on the quality and differentiation of our product and on the price point that we've entered the market in. We will be expanding that lineup as we bring additional pre-rolls to that category as we move into the new year. And we're also expanding on our CBD medical portfolio. The wellness space is one that will be growing, specifically when you see new cannabis consumers come into the market who may not have traditionally or historically thought that they would be using these products. We've seen an excellent growth, not only on the medical side of this business, but also on the adult use side for your non-traditional cannabis consumer. And we also know that this portfolio is one that would transition very nicely over into the OTC category when CBD eventually becomes legalized. We have taken an opportunity to focus on products that help patients. An excellent example of this is our omega-3 CBD soft gels, and more recently, our nightcaps product, which combines CBD and melatonin to help people in their everyday routines and life, and when they're looking really to have that consistent health and wellness ritual and routine.
Amazing. Okay, so having a good understanding of the business now, what you guys are doing and how you look at the marketplace and especially your consumers to see what's coming next. We want to look at recent news too and other things that you guys have been up to. The most recent news, I think, when we talked with your team earlier this week, you guys had just had your annual general shareholders meeting. I'm not sure if there's anything specific that you can bring out of that, but is there anything that you want to highlight from that most recent meeting? Anything that you want to share for investors?
Yes, thank you. So we just had our AGM actually this Tuesday, and this was really to report on our year ending. We've now moved into a new fiscal year. Some of the key highlights for us is that if you go to the second slide, which really looks at the demographics and transition of the business, that will show you specifically the change in revenue growth. Perfect, that's it, of our company. So if you look historically at fiscal year 2022 and the transition of that to Q1 of fiscal year 2023, you will see that it has been a dramatic shift in the way in which our business is positioned. We, as I mentioned earlier, we have moved from 90% being a wholesale producer a year ago to now 90% being a branded cannabis revenue producer. And that's really largely made up of our net revenue increasing by over 67%. And this was an instrumental decision that we made to really shift the business to ensure that all of our flower would be going into branded cannabis products. And when you look at the flower that we produce, this comes from a greenhouse flower, indoor flower, and we are the largest outdoor producer of flower from our Port Perry site. Historically, we would have other LPs that would purchase our outdoor flower to use in extraction. Now we've created brands in the milled category and the pre-roll category where that flower goes directly into branded cannabis revenue. The importance of this is, significant in the fact that you increase your margins dramatically, and we've also increased our revenue base by over 67% in the last 9 months. So that's one major transition of the business. If you go to the next slide that's called aggressively capturing adult use market share, you will be able to see the growth in our LP rank over this period of time that was presented at our annual general meeting. A year ago, we were close to 30th position in terms of the adult use ranking in the market. We have now rose to 12th position with 2 of our products, our pre-rolls there that you see on the screen, Divi pre-rolls, and our flower hitting the 5th and 7th ranked positions, clearing the top 10. And our growth trajectory continues to show that we are the second fastest growing LP in terms of retail growth as based on high fire data. So the transition of our business has been, incremental, but also growing at a rapid rate compared to some of the other LPs. If you go to the last slide, it shows you the breakout of revenue. It's called Divi breakout results. This shows you the growth of, close to $100,000 when you look at it almost 14 months ago, to over $10 million in revenue of the Divi brand as reported of the last quarter. Significant growth of this business. I would say that our demand for product outpaces our actual supply. And we have also looked at ways in which we continue to bring innovative products to the market to help build on this portfolio. The other benefit of our business is that we've taken a very important strategic approach to really reduce costs. As you know, it's been a very challenging environment in the Canadian market for Canadian licensed producers to hit profitability. You can have, the strongest gross revenue, you can have the best top line sales, but if you're not profitable, that's not a sustainable business model. We have taken out over 10 million in savings out of the company over the last 7 months. We have reduced our SG&A from 9 million to 4.5 million as reported in the last quarter. And we have completed complete overall company cost rationalization and restructuring to make sure that we're a very lean organization that is focused on aggressive growth on the top line, but specifically with high margin products. And our objective is to become one of the first publicly traded companies to be EBITDA positive, which we're on track to hit at the end of this fiscal year.
Outstanding. Now, you mentioned your revenue base too, and I'm glad you brought that up because I wanted to talk about some of the revenue growth that you've seen. 12 million total net revenue in the first quarter. It's a 13% increase over the prior year. And then also 43.1 million in net revenue in your 15-month fiscal year. Those are both big increases. You talked about your revenue base, but what are some of the drivers that have led to some of this revenue growth that you've seen? And what are you guys going to lean on more heavily to keep this momentum going into the future too?
So the first largest driver is moving from wholesale cannabis to branded cannabis, because this is repeatable purchases and sales where you have products that you've developed a loyal consumer and customer base for. When wholesale revenue is spotty, it's opportunistic. We have really leaned into the Divi brand. We have a phenomenal following with that brand. Are also being very thoughtful about the types of products that we continue to extend on that portfolio. One of the most important things in the cannabis industry is you can't be all things to all people. So we've really tried to be very specific on how can we add additional SKUs and products that are line extensions to our portfolio that will help to increase margin, but that are not necessarily going in a completely different direction. So when we know that the pre-rolls are doing exceptionally well, we're continuing to ensure that we have pre-roll SKUs across every element of that value chain. Same thing with formats of flower. Not only do we offer, a 3 gram format, but a 14 and a 28. So it's important that you have the spectrum of that product once a consumer is engaged with it and has product they will have repeat purchase through, that you're offering different formats and volumes and sizes. One of the other strengths of our business is that we have a direct sales force. So our direct sales force is specifically Aleafia focused. They are experts within the cannabis industry. They are aficionados in their trade. They only represent our brands, and they develop very strong relationships with the bud tenders and the retail stores, which helps ensure that we are always on the cutting edge of the newest products that we'd be bringing to market. But it's also important because it allows you to have that shelf space. So we will continue to focus on expansion, not only of our SKUs and portfolio as part of the growth, but within specifically just those high margin areas. So in flower, pre-roll, and vapes. But we will also start to expand into more of a national presence. Historically, we have only focused really on Ontario and Alberta, with more limited sales in BC and Saskatchewan. And this has specifically been because we wanted to establish a depth and penetration in the two largest markets. We now have the opportunity to expand into the rest of the provinces in the Canadian market, and this will help increase to ensure that we have a national portfolio and will help to drive that revenue growth to a new level. The second lever in terms of how we're going to continue at the same type of rate of growth is our international business. We have secured two international partners, and most recently volume commitments for over 4.5 million annually. We have created our indoor craft facility that will directly focus on international distribution. We now ship to Australia and Germany, and we've had historical shipments to the UK. And this will become part of our broader expansion into that market that will help augment offset the lower margins on the recreational side to ensure that we have a very high margin business, driving to cash flow positive next year.
Amazing. Okay, a lot of good info there. I also want to look at the potential market opportunity from your eyes, right? When you look at your industry as a whole, what Aleafia is doing right now, all the different parts of your business that come together to make you what you do, what would you say are the potential market opportunities for Aleafia, for the industry as a whole, and how much market opportunity do you think you guys are going to carve out over the next 5 years?
Yeah, that's an excellent question. This market is changing dramatically, as you know, quarter over quarter. I think you're going to start to see a lot of consolidation in the Canadian cannabis industry. You have, some of the larger, top 10 main players who have produced significant flower at scale and who have taken a large ownership in the leadership position in some of those big categories, specifically, the flower and the vape categories. But you're also seeing that those larger producers are starting to lose share at a dramatic pace. And it's some of the up and coming rising LPs, such as ourselves and a few others, that have really capitalized on bringing products to market that consumers want and ensuring that you have high quality products that are repeatable and consistent. And that has really allowed some of these smaller LPs to start to steal market share and become a major player on this side of the business. I also think when you operate at such a scale like that, you're going to have challenges on maintaining your position and just on the cost that it takes to be able to drive that type of volume. And the infrastructure to support that long term will not allow for profitability. I think you will start to see that there'll be amalgamations and mergers between those companies, that range from the 15th to 10th position, where coming together where they have like synergies will really help establish a competitive presence. You will also see companies that will just not be able to sustain the level of cost investment with the margin profile of this industry, who will fall by the wayside. And I think big changes will have to come specifically in Canada with regards to the excise tax and the percentage that the provincial and federal governments take from this business. Unfortunately, they're not the high margins that were expected, initially in this industry, with excise tax at some points being north of, 30, 35%, which puts a significant strain on not only the producers, but then also on the ability to ensure that you're running a profitable company. I think on the actual retail side of the business, you're going to see a lot of these independent retailers will not be able to sustain the inventory levels. You've seen the growth of, cannabis retail shops on every corner within the same area. And it's very difficult to compete with your competitors down the street that are more, provincially based or have national distribution. So I think you will start to see consolidation and amalgamation of retail stores. And I really think that it's going to be the companies that are able to get to profitability quickly and maintain that level that you will see that will be maintained. It's very similar to, if you look at the pharmaceutical industry, about 20 years ago, you started to see significant amalgamation between companies that had synergies. I think you will see something very similar here in the cannabis industry over the next 18 months. You're also probably going to see a transition in vertical integration. It was once thought 2 years ago that a company needed to be everything from seed all the way to sale. So growing your product, cultivating your product, producing innovative brands and products, and then distributing those. I think you're starting to see some companies that have mastered cultivation and are able to consistently grow high quality, high THC, innovative strains, innovative genetics. They may not necessarily have the branded excellence or the presence in the market, but they can supply that excellent quality flower. And then you see other companies that have really mastered creating the brand. And that's something that we're very proud of in the brand that we've created with Divi. And not necessarily do you need to be vertically integrated to ensure that you're not only growing your own flower, but that you are doing the entire process. So I think you're going to start to see a transition on where companies focus and that they own certain strengths within the portfolio as we start to see consolidation in the Canadian industry.
Wonderful. Tricia, it's been an absolute pleasure having you on. We're running slightly over time, even though I'm sure there's a lot more that we could break down and discuss with you. We hope to have you back on again soon. Tricia Sims, CEO of Aleafia Health, thank you so much for being here. We're going to move directly into our next presentation with our next company and bring on David Stieber, the CEO of the Levento Group.
Hi. Hi.
David, thank you for joining us. How are you?
Yeah, I'm very well. Thank you. How are you?
Doing great. It's great to have you here. Hopefully the morning is going well so far. Give us a little overview of Levento Group. It's your first time here on All Access, joining us with our live audience of retail investors and traders. Give us a little context about the business and what Levento is all about.
Yeah, so Levento Group is a holding company listed now on OTC market in States. So what we are doing, we have now one of our main let's say division is a Boxo production, which is making movies with Hollywood teams and Hollywood stars. And we are mainly focused now on this particular, let's say, branch and division of Levento. We have as well portfolio system that is used by some family offices and asset managers called LEC, which is what Levento started originally with a few years ago. And then we prepared as well one project that will be separately listed in Europe, which is focused on logistic and technological environment, let's say. So this is something that we have in Levento, which is company now having around 12 employees in States. I'm based in Europe, and we are mainly focused on Boxo, which will help us to bring the company to NASDAQ.
Amazing. Okay, so you mentioned bringing the company to the NASDAQ. I want to talk about that. Bring us through some detail about why that's going to be so important, but also anything else exciting going on for the Levento Group. Give us a couple of things that are really significant on your horizon right now.
Yeah. Sure. So the main topic in Boxo is that we have very direct access to the right, let's say, intellectual properties, I would call it, which means to scripts, to books, to even newspaper articles, which our team is reviewing and buying. They are coming to us from agencies in Hollywood, even from the biggest one like CIA, and we are just selecting them and choosing the right ones. which we are then partnering with some top-known directors, and we are trying to bring the best script writers, which usually accept, to create a full script, and we are building a package of a movie. And the main advantage is that this package, to create this package is very good because it brings us the opportunity to lock as well in very initial stage a distributor, which is doing usually pre-sale of the movie, which is helping to again secure the needed funding to produce the movie and to make then the actual filming, which is costly. And we have then from the movies, which are usually are successful, they have all box office revenues over $50 million. So through our revenue and profit sharing, we are getting to 5 to 15 million, let's say, revenue from each of these movies. And this is one of the main reasons how we want to get a company to NASDAQ. Because now in the next 2 years, we are able to increase the revenues very significantly through this deal that we prepared for Levento, let's say, and through our team.
Amazing. Okay, now, David, we have your deck pulled up too. I want to walk through this really quickly. Give us any of the highlight slides in here that you want to cover and walk us through so we can get a better understanding of the business model.
Yeah, sure. So we can maybe go to, I think it's like number 3, competition advantage. Yeah, so this is what I spoke about. So I would say really the unique selling proposition, which is the number 4 on the slide, where we exactly know when we do the package who is doing it, why, who is the actor starring in it, and where the movie will be, let's say, sold, which cinemas will take it over. And this is really something that not most of, let's say, any other production companies can say, because usually we don't need to look how to finance the movie, right? We just need to choose the right content, which is coming to us, and produce it in the right timing. Yeah, we can then go to some maybe to few more slides just to show what we did in the past. Here is just quickly business features I just explained. So it means secure revenue. We even can call it this way because most of our revenues are already secured when we choose the topic to work on. Then definitely diversification, because through this model we are able to start one project every month. Yeah, so we are getting to a position when in let's say 18 months of work we will have 18 projects that we are working on, which is getting big diversification. So even through there is some delay in one of the movies, okay, there are others coming through. And percentage from revenues, the last point, it's very, very important, because if the movie is really successful, can bring very top notch to our, let's say, revenue pocket.
Outstanding. Okay, so I'm looking at a couple of headlines here on Benzinga Pro, actually, to look at the company. I'm looking at a headline about Levento taking a lead in providing environmental technology with the Eurodot project. I want to talk a little bit about the Eurodot project. It's something we got a couple of questions on leading into this conference, actually. Give us some context about that and why it's so important. Yeah, sure. So Eurodot project is already being prepared, let's say, for last 1.5 years. It's a holding that is that currently there are 2 companies that will join the holding from the beginning, focus on technology, environment in logistics. Yeah, so it means there are companies that are focused on Green Deal, that have long trucks, some long haul trucks, and they need to grow, right? So they approached us how they can secure the future, how they could grow. So we prepared a project how to put them on a stock exchange, offer them to investors, and boost the value. So the main point from the big numbers is that these companies have now revenues around $15 million, which are first 2 companies, and their combined value is reaching 25 million. And in the next 6 to 10 months, once the holding is listed on one of the main European stock exchanges, so we will put there another 2 companies that are ready, and the total value of it will be $70 million. This combines revenues above $40 million. And Levento holds 15 to 18% share in this holding. So this is one of big values that we are adding to Levento shareholders, where there is no need to invest anything from Levento to this holding, but we are getting this holding based on the work that me and my team provided in the last 1.5 years. Got it. Okay, very exciting. And also, you guys have not only this stuff and everything that you're working on with current projects going on, but a lot of other exciting things that you don't hear too much about. You've got relationships with Peter Jackal, Ara Kashishian, Martin Barab, some of these larger celebrities in some of these films and everything else. How did some of these relationships start, and how do you continue to develop these relationships as the company goes along?
Yeah, as you can hear, I'm not American native, so I live in Europe. And Peter Jackal is as well living in Europe. In fact, he's in the same country, Czech Republic, in Prague, where he's originally from. And yeah, we were looking for a business that could trigger the revenues, that could help. And I met Peter by some kind of coincidence, as it usually can be. And we spoke about it a lot. He told me what he's preparing, what he's doing, how this system, how let's say this business works. And we found out we found out this business model working. We adapted it to what I believed that is the best way for let's say the stock exchange to accept it, and as well to boost as much the revenues as possible in the near future. So it means not to make big movies with own equity, but to focus on these development packages where it's much more, let's say, diversified, and it's securing the revenues for the future. So this is how it started. And Peter is very long time working with Ara and Martin. They know each other, so I'm visiting them in LA kind of regularly. It's great guys to have in the team.
Got it. Now, when you look at your market specifically the last couple of years, do you feel like COVID has been not necessarily a catalyst, but has it increased your market size for your opportunity to go out there and attract a market of viewers and consumers? Do you feel like COVID has been kind of an opening and an opportunity in that sense for the company?
Definitely. I would say that it is one of the reasons why we choose even this business model, right? Because exactly the online streamers generally, any of the names that are now on the table, and we have them in our TVs, it's requiring more content. Yeah, and it's even now after COVID coming back with cinemas, right? Where, okay, during the COVID, most of it was shut down, but now it's again coming back. And on top of it, COVID increased the demand because of the online streamers that need the content. So definitely COVID supported what we do and supported the decision to use this business model we are currently using.
Understood. Okay, so what have you learned from the IPO market? We talked about Eurodot just a second ago, but what have you learned from the IPO market recently? The IPO market itself, what does it look like right now? And obviously, we've had some difficult market conditions in the last year. I think it's certainly an understatement in many ways. Mm-hmm. What do you think the IPO market looks like as we've had some bumps and bruises in the market? We've had some downturns. How do you feel like the IPO market is going to continue to grow over the rest of this year and into next year?
I believe in this market generally, and I see it on other companies like ours. It's not always depending on the total market, on some big, let's say, market makers or on top companies in Dow Jones Index. It's always about the project, if it's interesting, and because we speak to, let's say, investment bankers, I would call it, so main let's say main people with money that are then supporting these IPOs. They still have the appetite. They still believe the projects can grow. They're just looking for the right type of the company they would put the money in. I believe that there are money out there. It's just much harder to deliver the right project that they would be more likely to finance. This is how I see it.
Got it. Okay, now you guys have it's a very vibrant business model. Can you talk a little bit about the culture at the company, at Levento? What are some of the executives and the team members kind of come together in terms of culture to make the company go forward? And how would you describe the team as a whole and how it helps the business grow?
Definitely. We started as a small company, let's say a few years ago, from the time we moved up. I believe that our team, I would describe like everybody needs to work, and we are all, let's say, seniors in our roles. You know, we are not big enough to have juniors. So everybody in the company is usually hired with clear vision, with clear strategy, what he needs to do, and it's senior enough to reach the targets. And this is a system that I'm applying and that I like, and that the people need to follow, because it's bringing the maximum, let's say, performance and effectivity in everything we do. So you will find within the company experienced professionals. We recently hired 2 new people in US, in New York, Miami, LA. We have bases everywhere. So we're spreading it out, and everybody can, let's say, bring some ideas on the table, and we are just trying to find out what's the best way forward in the current situations of the market.
Got it. Okay, a bit of an off-the-wall question here, right? But again, like I said, you're in a very interesting, very vibrant industry. What are a couple of pieces of advice that you might give to somebody getting started in your industry? If you're looking at, the future of your sector heading down the road over the next few years, where do you see that going? And what would you give in terms of advice to somebody who's just getting started in your industry and what they should plan ahead for over the next couple of years here?
This is always a very interesting and not so easy questions to answer. Why we did it, why we did this, and what I see in the markets, and maybe you see it within the Nasdaq generally and all these IT companies and technology, which is always somewhere around. I believe it's a focus on revenues and on your customer. One of the reasons why Boxo is for me, even personally, and for the team, so important and can be the driver to Nasdaq is that we don't need to search for customer, right? We don't need to. We found it, right? We found a customer. We know where are the revenues. The only thing we need to do is to find the right content, the right projects, prepare them, and package them. Yeah. So I would always say, because I was working as well 6 years for a venture company before I did Livento, so you see a lot of projects out there, a lot of good companies, a lot of very skilled people with a great track record. But mainly what we always found out, if they don't know who is the customer and how to get to him I would say easily, or how to approach it, it's always an issue. So you need to focus on who is giving you the revenue, who is giving you the money, how you will find him.
Amazing. Okay, so any things that you would want to point out to investors now specifically, right? We're here with the retail investor audience, individual investors. What would you want to point out about Livento specifically over Q4 for the rest of this year? But if we're looking at 2023 as well, big growth plans, big milestones that you're looking to achieve, what should investors have their eye on?
Yeah, definitely what I would point out, as we discussed, is Boxo production, the coming to realization phase, and our big potential in revenues. And not only potential, but the revenues that will start coming in, that will move the company towards Nasdaq. Yeah, because we know what are our limitations right now. We are working on the legal stuff, so we are now finalizing some steps with SEC. We are moving the company forward, and next year, I believe all this, not believe, but we see that this will end this year, and through initial quarters in the next year, we will get the revenues to Boxo and to Livento on the level we need them to get to Nasdaq. So this is what the retail investors can be looking for, because with this we can really make the change.
Outstanding. Like I said, obviously a lot of exciting things coming up for you guys. And even in just a short amount of time, we've gotten a lot of context about Livento and what you guys are doing. Obviously, we're hoping we have you back soon to hear more about some of the milestones you guys are going to go after and some of the things you guys are going to do in Q4. But David Steeper, it's been an absolute pleasure having you on. Thank you for joining us this morning.
Thank you for your time and the possibility to speak. Thank you.
Hello, everybody. All Access. We're going to wrap up with another company here right at the end. Before we bring on our last company for All Access, we're going to talk news items of the day, things that are going on in the headlines and things that are actually moving the markets and things that are going on around us. We've got some actually really interesting headlines. One of the things we've got is the FTC officials investing in companies they regulate, something we reported on this morning. We're probably going to do another interview on later in the day. But officials from the Federal Trade Commission owning and trading stock in the companies that were undergoing FTC merger review or investigation. So people that were getting involved in these companies as they were reviewing them for the FTC and taking stock, which is obviously not something you ever want to get involved in. If you're evaluating a company for its eligibility for the FTC regulations and guidelines, investing in them is not something you can do with that kind of inside information. So this is a headline that came out this morning. A bunch of companies involved like Amazon, Meta Platforms, Alphabet, Microsoft, and Oracle, all these companies being evaluated on an FTC basis and then having people invest in them as they were doing the evaluation. So that's a headline that's obviously going to affect some of these companies. And of course, the people that were getting involved in them as they were doing the evaluations and those rigorous guidelines that they set up to kind of run those companies through. So something to keep an eye on there for those companies, especially Amazon and Alphabet, two big names to keep an eye on. Kroger buying Albertsons for $24.6 billion. Kroger, obviously one of the largest retail outlets for groceries, buying Albertsons out at almost $25 billion. Massive acquisition. Combined, they employ more than 700,000 people across about 5,000 locations across the states. Big acquisition. Something to keep an eye on there. Kroger's is obviously one of the biggest names out there, and combining with Albertsons gives them a much more expanded reach and is probably going to give them a much greater coverage of the grocery sales across the United States. So another thing to keep an eye on there, mines waste being used to mine Bitcoin. A really interesting headline that came out this morning. Stronghold Digital Mining is using waste from the Panther Creek coal plant in Carbon County to power its Bitcoin mine. So Uni's using the refuse from Bitcoin production to actually mine new Bitcoin. It's a really interesting concept, not one that we've actually run across before, which is why the headline kind of caught our eye. But interesting. Another one to keep an eye on there. This could be a new wave of Bitcoin production using the waste and the refuse from old Bitcoin production to make new. Something to keep an eye on. Could be really impactful as far as how much waste we're actually just letting sit there after the Bitcoin is mined. Could be a new way to repurpose that and create new Bitcoin. So another headline there to keep an eye on. And Google unveiling its first smartwatch. It's the Pixel Watch, the first ever smartwatch, which they released yesterday on Thursday. It features the health monitoring software and requires an Android device to run apps and gather data. So Fitbit is obviously the reigning fitness tracker until about the Apple Watch was introduced in 2015. And then Fitbit sales took off and the stock price tanked after those sales kind of slowed down over the first year or two. So Google coming out with its first smartwatch could see a dent in the Apple Watch sales, which of course everybody has an Apple Watch. It's all over the place. So we'll see if Google is able to make a dent in that market with their first smartwatch. The only other big headline we're really keeping an eye on as of this morning is Coinbase getting regulatory approval in Singapore. So they got this key regulatory license to provide regulated digital token products and services in the country. Despite the collapse of the industry and layoffs in the company, the crypto exchange has remained steadfast in its international expansion. So Coinbase obviously still looking to move outward, not staying where they are, but trying to get into new countries, new territories, and move their products and services across the world. So another one to keep an eye on there, Coinbase, and see if they're able to start moving into new territories. So moving into Singapore, obviously already getting started in new places. With that, that is our headline check for the morning, everything that we're keeping an eye on, and we'll have more reporting coming out on that across the rest of the day. But with that being said, we do have a couple of other things that we want to run through. So the other headlines that we're keeping an eye on, other than the headlines we already ran through, is also Netflix unveiling their ad option for streaming services. On November 3rd, Netflix will offer a $6.99 subscription plan, basic with ads. That's going to show users 4 to 5 minutes of ads per hour of content they watch, which is kind of confusing to me when I read this one because I thought that they already were trying to aim away from ads, and I guess they're going back to it. So basic with ads is their $6.99 subscription plan that's going to add 4 to 5 minutes of ads per hour of content. They're going to range from 15 to 30 seconds, which, again, a little bit confusing because I don't like ads. I don't think anybody likes ads when they're watching Netflix. I don't know that it's a bad idea for them, but I do think this could see a dent in their subscription numbers. Nobody wants to see more ads. And if you're going to a basic plan, which is going to have 4 ads every couple of minutes, I don't think it's a great move for them, but we'll see if it makes any dent as far as what Netflix is doing. So there's another headline on that side of things. And then another one we do want to run through. I know we said we were done with headlines, but we did have a couple more come in just a second ago. The UK finance minister was ousted after their market chaos this week, less than 6 weeks after starting in his role. It was Kwasi Kwarteng. His controversial tax cuts, which he unveiled in September, sent the British economy into a tailspin. Prime Minister Liz Truss, who originally supported the plan, walked back on her commitment to it. So something interesting here, because the UK finance, obviously right now, a lot of problems going on. They've got massive inflation. They're seeing a lot of the same problems we are in the States, but they've got issues with their finance cabinet as well. So we'll see what happens on the UK finance side of things, but their finance minister being run out of there after only 6 weeks in office is obviously controversial and obviously displays some of those problems that they've been having with their economy as a whole. So another headline there to keep an eye on. One thing we do also want to mention is our interviews with Anne-Marie Band, which we do every Friday and then release the next week. We haven't been able to do them the last couple of weeks. Unfortunately, Anne-Marie and her family are in Florida, so they dealt with a lot of the pandemonium and the issues and the turbulence that were going on down there with the hurricane. they're all doing well. Everybody's fine, but we have put those interviews on hold for a couple of weeks. They've been without internet, without power. They're getting back on track. We're hoping to do our first one today for the first time in a couple of weeks. If we can't do it today, next Friday, we'll definitely be back on. And we'll take a look at the markets. Anne-Marie gives us not only what's going on in the markets as far as reports, everything that's going on from a regulatory side of things, she also gives us trade ideas and ways to position yourself in the market, hedging risk, but also getting ready to see what's coming up the next week beyond. Shorts, longs, stocks to get involved in, stocks to play with, and ways to position yourself in the market for financial success. So we're looking forward to having Anne-Marie back on. It's been a couple of weeks. We're looking forward to getting those interviews back on track. So look for those. We should have another one ready to go next week. And obviously, you can always look back at some of the interviews we did with Anne-Marie Band on Benzinga Pro, on Benzinga's YouTube, and of course, all the other places that we promote them on our channel. So keep an eye out for the next interview with Anne-Marie Band. Just looking across Benzinga here before we get to the company we're going to close out All Access with in about 1 minute. Nothing else crazy going on at the headlines today. Looks like a pretty quiet morning. SPY down about 1.4%, Bitcoin up about 0.1%, the Dow down about 0.7%. Pretty quiet day, not a lot going on. Even Benzinga.com, not a lot of crazy headlines. The Jim Cramer headlines and the fund that you can invest in to go opposite of his picks is a fun story if you're reading around. I would check that one out. It's really interesting to see the negative sentiment against Cramer's picks and how you can actually invest directly against those. So keep an eye on that one. If you do want to read something fun, check out the headlines on Benzinga.com. We do have some really fun stuff about Cramer on there. Only other thing we're looking at is Tesla topping auto stocks for short sellers. Ford, NIO, Lucid, and Rivian all kind of fitting together here on these short seller reports. This is an interesting one. Tesla short sellers have generated $8.6 billion in profits in 2022. So the short sellers have been winning on this one for a while. And it's important to note that obviously, Tesla is something that banks on their reputation and what they're trying to sell and produce to kind of keep their brand strong. So the short sellers generating almost $9 billion in profits in 2022 is significant. Something to keep an eye on there. It's the most heavily shorted stock in the auto industry, which obviously says something about a lot of the negative sentiment out there. But it's something to keep an eye on. Auto and truck manufacturing stocks, they currently have $27.6 billion in total short interest, with Tesla having almost $9 billion of that, obviously taking up a huge chunk of that short interest as a whole. But the short interest has been increasing for the industry as a whole for almost the entirety of 2022. So if there is something to keep an eye on when it comes to the auto industry, Tesla and the significant short interest they have is something you'll definitely want to keep a watch on for the rest of this year. With that, we have arrived at the time where we're going to bring on our last company, Willamette Vineyards. We're going to go ahead and get the CEO on in just a second. We're going to switch things over and bring on Jim Bernau. He's the founder and CEO, and the company name is Willamette Valley Vineyards. They're traded on the NASDAQ as WVVI. Let's bring him on. We'll go ahead and get started. Jim, how you doing?
Good morning, Michael. I'm sitting here in the Roumage room in the cellar of our sparkling winery.
Fantastic. All right. Really interesting location. Thanks for coming to us from there. Where exactly is this located? Where are you guys at?
This sparkling winery is called Domaine Willamette. It's one of Willamette Valley Vineyards holdings. It's brand new, and it's located in the Dundee Hills of the Willamette Valley.
Fantastic. Okay, let's start off at a high level, right? You're coming to us from an interesting location. We want to hear more about that. But give us a high level overview of the company. What is Willamette Valley Vineyards? What is the background of the company? Tell us a little bit about the company as a whole.
The Oregon wine industry is actually very young. For us at Willamette Valley Vineyards, we're one of the very early in the industry here. We've been growing since for over 40 years, since 1983. And Oregon has taken its place among some of the finest wine growing regions in the world in just that short period of time. In the Willamette Valley, we specialize in Pinot Noir. And of course, that makes great still wine, red wine, but also wonderful sparkling wine, which you see in the Riedling racks behind me.
Fantastic. Okay, so let's dive into a little bit more of the business and what you guys actually do there. You guys have a really rich history, and some of the notes that I'm looking at here and some of the things that we researched, it spanned from you having wine being served at the White House to appearing on the TV show Friends. You guys have a really diverse background and a lot of really interesting history here. So can you walk us through a little bit more of the background of the company and the history of how all this got started and what makes Willamette so unique as a company?
It's really not that long ago, Michael, that it was discovered that in the Willamette Valley, Pinot Noir and other thin-skinned grape varieties could be grown so well and made into world-class wine. The company I started a little over 40 years ago, has now grown into an ownership of wine enthusiasts of over 24,000 wine enthusiast owners and about 9,000 wine club members. And we principally focus on Pinot Noir, but we also grow and make wines from other unique growing regions of Oregon.
Terrific. Okay, so as far as I know here, right, and correct me if I'm wrong, but Willamette was the first ever winery to go public. Can you walk us through the decision to go public, what that process was like, and what a difference it's made for you guys since that happened?
You know, when I started many years ago, I wanted to have a winery that was owned by wine enthusiasts because I believe that that was the best way to form and grow our organization. And it's given us great strength. I started first we actually conducted the very first self-underwritten public stock offering in the country called Regulation A, and became actually the poster child of community-based crowd-funded companies. And since then, a whole fabric of state and federal laws have been created around the experience. When we started doing this back as a public company in 1989. And so that has, and over that time, it's allowed us to plant more vineyards, to build more winery capacity, and to provide excellence in various types of wines to consumers throughout the United States and in various parts of the world.
Terrific. Okay, so knowing the significance of going public and where you guys have come from since that decision was made, what's the current financial position of the company like? What is cash on hand like? What are financial operations like? Can you take us through the business side of Willamette a little bit?
Yes, I mean, we've grown, from what I started, a chainsaw and an old tractor, into a company now that has substantial equity invested in it, both in terms of common and preferred stock. Most of our capital comes from preferred stock, which is the offering we're doing now. We're offering preferred stock directly to wine enthusiasts. And that is really what's allowed us to continue to grow so rapidly. Some of the things that the reason why wine enthusiasts are interested in investing in our company is because of the benefits that they receive, as well as having that strong financial strength behind the company. For example, the facility I'm sitting in is owned entirely by the shareholders. There's not one nickel of bank debt in this new sparkling winery. So there's a lot of safety in investing in our company because of how much equity, how much capital is brought to bear by our shareholders.
Very interesting. Okay, makes a lot of sense. And another thing we want to cover as well is the environmentalism side of thing. When you're talking about the world as a whole, environmentalism has become a much bigger topic over recent months and years. What do you guys do at Willamette when it comes to environmentalism, protecting our environment, trying to keep things healthy and green? What are you guys doing at the company to try and drive that initiative ahead?
This is very important. This issue that you talked about is very important to us as wine growers and winemakers, but it's also very important to wine consumers because they're experiencing now in their own communities the dangers of not looking after our environment properly. And so what we do is helped start an organization that provides very strict standards for how you grow your grapes to make sure you're not harming the soil, you're not harming other living creatures or harming your neighbors. And so we've implemented a number of strategies. One of them, for example, is we collect rainwater during the winter, and we use that rainwater to drip irrigate our vines, which means that we don't have to draw from the river during the summer, which would harm the fish, and we don't have to drill and pull it out of the ground at this vineyard location where we're starting this process of retaining rainwater that's otherwise wasted by flowing out into the Pacific. So the importance of walking as softly as we possibly can in everything we do and protecting the environment and our customers is really important to us, and it's important to all Oregon wineries.
Absolutely. Okay, really good breakdown. Now, when you're talking about what you guys produce and everything, what does it look like as far as the fermentation process? How many employees do you guys have at your groweries and your wineries and the places you're actually growing these grapes? Take us through the side of the process a little bit of how your product actually comes to the market.
Michael, this is a great time actually to be talking to you because we're right in the middle of harvest. And boy, is it an amazing harvest. It's, we're in the Willamette Valley, Michael. This is a pretty cool climate state. And that's one of the reasons why Pinot Noir performs so well in the Willamette Valley. And actually, it's going to be 82 degrees this afternoon, Michael. We have had one of the most idyllic, dry, warm harvests. And that's actually been happening much more frequently, which is one of the reasons why these grapes and these wines are performing so well and have over a number of years. So we're bringing that fruit in. We're about halfway through our harvest. We'll be fermenting those grapes and going through a process. Some of those wines will be released fairly early. You probably heard of our whole cluster fermented Pinot Noir, which doesn't stay in the cellar that long. We'll release that in late spring of next year. And then some of our other Pinot Noirs will age for over 18 months in barrel. For example, here behind me, you see sparkling wine that's going through a secondary fermentation called method traditionnel, which is the classic method in which the champagne producers use. That secondary fermentation produces those bubbles in the bottle. And we actually lay these bottles down for 18 months in this cellar while they ferment in the bottle. And so it'll take sometimes up to 2.5 years before we, when we go from grape to the release to the customer.
Interesting. Okay, awesome. Great learning a little bit more about the process here. And I think it's really interesting, too, what you mentioned where you guys are having these idyllic harvests and everything's going really well, where we've had so many issues with the supply chains and growing conditions and crops and everything else across the world, not just in the U.S. So if you're looking at the macro scene as a whole, your industry and across the world, not just the wine industry, but the food industry as a whole even, let's look at that. Do you see any major headwinds that you're concerned about for the wine industry, the food industry, anything that we should be concerned about in terms of weather, of crops, of supply chain issues, anything you see on that front?
Michael, it's not easy to tell you this, that somehow we here in the North Willamette Valley are kind of an unusual beneficiary of the changes that have occurred in climate. And that's one of the reasons why Oregon is performing so well over the last 15 years. The growing conditions of producing high quality Pinot Noir in particular, thin skinned grape varieties like Chardonnay, match this change in weather precisely. And so we're one of the few beneficiaries in agriculture and in industry from actually changes in climate.
Fantastic. Okay, and yeah, again, I can see why that statement wouldn't be easy to make, right? Because again, when you have so many issues going on around you, but it's benefiting you guys, it's obviously a difficult thing, but it's good for Willamette and the fact that you guys are able to succeed through all of the difficult conditions around you.
If you look to see what's happening, the California winemakers are coming to Oregon. We have French winemakers coming to Oregon. Oregon has become that last frontier. And where we have very sophisticated California and French wine producers that understand where the future lies. And it's here in the North Willamette.
Fantastic. Okay, makes a lot of sense. Now, let's talk a little bit about recent news. We want to talk about the earnings report that you guys had most recently. What highlights would you throw out from your earnings report that you guys released last, and what things should investors be looking at inside of it?
Well, the first thing to point out to you is that we've gone through a substantial capital formation and growth plan. And so what people will do when they look at the balance sheet and the income statement is they'll see that preferred stock capital being deployed. So we actually, over the last year, have developed a business that that has the capacity to double our revenues and our earnings. And we're now deploying that and activating that. For example, this winery just opened after an enormous investment that has been made. We've opened, for example, 3 outposts In other words, we've taken the Oregon wine story on the road into suburban areas like Lake Oswego, Vancouver, Washington, Folsom, California, where consumers could come in contact with our brand in tasting room restaurant settings, which is an important part of our growth strategy. So we now have 380 employees. In 2 years, we'll have 500. And our business model allows us to form capital, selling preferred stock into these communities, and raise the capital, but also the customer base to properly support our new outposts as we continue to grow. And my intention is to grow across the country.
Terrific. Now, there's another fun question I want to ask here too, but there's a saying about Willamette that you guys have trademarked and that you did in 2009. Is that right? Could you give us more about that?
You know, the people, especially east of the Mississippi, mispronounce the name Willamette. And so, yes, when we teach people to pronounce Willamette by saying, it's Willamette, damn it. And that's a way for people to remember it's not Willamette or some other pronunciation. And so, yes, we actually have trademark. We own the trademark Willamette Valley Vineyards. If you think about that, how significant that will be in the future as more people understand the quality that's coming out of the Willamette Valley AVA. We also own the trademark Willamette. And so the new winery, the sparkling winery, Domaine Willamette, will someday take its place among the finest sparkling wine brands in the world.
Amazing. It's a funny side note. It's an interesting thing, and we wanted to hear more about that. It was one of our favorite things we learned doing the prep for this before we came on. But love to hear that. The other thing we also want to talk about is the chief operations officer that you guys brought on over the summer. When it comes to personnel at Willamette, how has that impacted things moving forward so far? What kind of difference has it made, and what is the team made up like at Willamette? How important are the members that run the company?
We have a remarkable staff. We have a lot of women, in fact, although the new chief operating officer is Joe Padilla, who has a lot of experience in helping us operationally. The company's grown very rapidly, and we needed that. We needed to have that level of sophistication to make sure that we were effective in implementation of our growth strategies. And he's been here since May, and we're building a management team that will continue to support our rapid growth.
Terrific. And let's talk about that next, right? When you look ahead for the future for the company, what does that growth strategy look like? What is Willamette going to do over the next quarter, over the next year? What is it going to look like as you guys go forward? What are the strategic plans for more vineyards? Is it more people? What's the growth look like for the company?
Well, first of all, Willamette Valley Vineyards is the #1 producer of Oregon Pinot Noir over $20 a bottle in the nation. So we lead the nation in terms of the product that we focus on from Oregon. And we have well over 500 acres of vineyards that we manage directly and that we staff and farm. We'll be continuing to plant more vineyards and build more production capacity. We sold, for example, over 200,000 cases of wine last year. That's big for Oregon. We have something like over 750 Oregon wineries. The average size is about 5,000 cases. And this harvest will go to 260,000 cases in production. There is no kind of lifestyle limitation on where we're going to take this company for our investors. We're going to continue to grow it rapidly and smartly.
Outstanding. Really exciting looking at the future there. And you also mentioned all of these other, French wineries and other nationalities and brands moving into the Oregon region. Take us through the competition side of the business a little bit. What other competitors are there to Willamette? Obviously, you guys are one of a kind with what you do and who you are. But what does the rest of the wine industry look like in terms of competitors and other people in the space?
For us, we have few competitors because of our scale. But we do have Jackson Family, for example, who has come into Oregon there. But we've learned a lot from them. So it's actually produced a benefit for us. Bollinger, for example, the great French champagne producer, just purchased a winery here in the North Willamette, Ponzi. What Oregon has benefits, actually, Oregon benefits and the Willamette Valley benefits from these new players, because they give us a tipping point of energy and influence in the national and international markets. So we actually welcome them because of the strength and the reach that it gives our industry.
Wonderful. Makes a lot of sense. And a last point here too, before we close, you've given us a lot of info about Willamette and what you guys do. Is there anything specific that you would point out to retail investors, right, which is our audience and who's here at Benzinga consuming our news? Anything that you would give to the retail investor audience for things to look ahead to from Willamette? Anything they should know right now about the business? Anything significant you'd want to share there?
Absolutely. I'm to your listeners and viewers, if you drink wine, you might as well own the winery. And here's the advantage that you get. Not only is your investment well supported by the equity in the company, but you get a lot of owner benefits. You get 25% off on all of, from bottle one. You get free tastings every month, where you can bring your friends that otherwise you'd pay a $20 charge for each one of them. You get tours and tours that are scheduled each month that would up to 8 people that could cost you $30 a person. So that's a $240 savings on a monthly basis there. But the other is that the dividend that you earn from the WVVIP stock can be converted into a wine credit for 15% more. We have in this offering that we're doing right now, we're selling stock for $5.25 a share with a yield of 4.19%. But we offer 15% more value for those who convert it to a wine credit. And we've had 82% of all those new preferred shareholders choosing the wine credit.
Wonderful. A message to the retail investors there, and certainly a reason to get involved with Willamette, as I know we already are. You guys were generous enough to offer to send us some products, and I know the team is very, very excited to sample them and give some feedback and tell you what we think. So, Jim, it's been an absolute pleasure having you here. Thank you so much for joining us on All
It's great
Access.
talking to you. I really appreciated this. Thank you.
Thank you. Jim Bernau, the CEO and the founder of Willamette Valley Vineyards, joining us there. He was the last entry on All Access Day, the last company we have with us, so we are going to go ahead and move into the close and the next show or whatever else we're doing on Benzinga's YouTube today. A couple of things to note before we close things out. We want to go ahead and run through our sponsors. Of course, all the companies that present on All Access, thank you to all of them. And our sponsor, Ticker, who sponsors every episode of All Access every Friday. We're going to run that video for Ticker really quickly before we close, and then we'll end things out.
What is Ticker? That's right, Ticker with 2 I's, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Ticker, where investors discover shareholder perks and consumers become investors in the brands they love. Ticker. Start tickering today.
And that is it for us. Again, thank you, of course, to our sponsor, Ticker, and all of the companies that came on. We love doing All Access every week and getting this inside look at the companies that present, getting these questions direct to the CEOs. It's going to close it out for All Access this week. We've got more coming later today. Of course, keep an eye out for interviews with Anne-Marie Band and all of the other experts we bring on Benzinga's YouTube. We'll see you back here next week for All Access.